It's a pleasure to be here. This is going to be basics of insurance. We have to always start out with what is insurance because it's very misunderstood. From the point of view of a nonprofit, it's protection to help keep you operating and moving and sustainable into the future. It is one way of transferring risk away from your organization. It doesn't get rid of the risks that you face, but it can help you reduce that overall cost of those risks because one uninsured incident can bankrupt the organization, damage your reputation. There's a whole lot of impacts that happen from an uninsured loss. It is not the only way of transferring risk away from your organization. We're going to talk a little bit about contracts because one of the most common ways that you accept risks and take on risks of other organizations is through contractual risk transfer. Plus, the insurance policy is in itself a contract. Risk is really just your chance of loss. The most common ones that hit nonprofits would be injuries to your clients and participants, your employees, volunteers that are helping you to do whatever your mission is, and the public coming on your property, coming to your event, people who are not actual program participants, could be parents of participants, damage to your property, your actual physical property, and theft or fraud to the organization. There are a lot of methods for handling risk. One of them is to just avoid it. We're not going to do this thing because the risk is too severe. The risk to the organization, the risk to the people, the risk to our reputation. There are all kinds of things that can cause the methods for handling risk also include reducing or mitigating it. So we're going to take this action to reduce the chances of or reduce the severity of a potential injury or potential damage. The other way is to transfer it through contracts, through an insurance policy, which is a contract. And sometimes it's uninsurable. You can't transfer it away to anybody else. You can't do much to reduce or mitigate that risk. So you just have to accept it. But if you accept it, then what you need to do is plan to have a plan for paying for that potential risk. So I've mentioned contracts a couple of times. The insurance policy is a contract between you and the insurance company. Your insurance broker, which I'm going to show on the next slide, is not a party to that contract. They're going to help you find it. They're going to tell you what potential uncovered hazards you may have. They're going to help you choose the best policy for the best cost. But that contract, the actual insurance policy, is between you and the insurance company, your organization and the insurance company. There are what we call both standard and non-standard insurance contracts. The typical standard policies are ISO. And by standard, what I mean is each company is going to use the almost exactly the same or very similar wording and coverages between the policies. Non-standard policies, such as most directors and officers policies, professional policies, sexual, physical abuse and molestation policies, and cyber insurance, just as examples, are typical non-standard policies. Each company writes that contract themselves. They may have similar wording, similar coverage, but there could be differences. So those non-standard ones can be very tricky to compare to each other. The insurance marketplace, and this is where I find a lot of people don't understand. Here's your nonprofit over here on the left, and then you have this circular insurance marketplace where, and I've put CNIS as the broker, but you have probably a different broker, but CNIS is what the acronym we use for our organization. But you have your insurance broker there, this person who's helping you find the right insurance policies. And they may need to go to a wholesaler or directly to an insurance carrier, directly to risk retention groups. Lots of ways to get to the policies that you need. Then behind all of that on the other side are reinsurers. And right now in the insurance marketplace in California, actually across the entire country and probably the entire insurance global system, we're in what's called a hard market right now. The last time we were in a hard market was right after 9/11 in 2001. What happens in a hard market is capacity shrinks. The amount that an insurance company is able to put out there for limit is reduced. A lot of that is reduced by their reinsurance contracts. We can use any insurance carrier, Farmers Insurance for your homeowners, or Chubb for commercial insurance, Nonprofits Insurance Alliance. Any insurance carrier has reinsurance on the backside that limits their potential exposure. So it is less expensive for them to purchase basically an insurance policy to insure their book of business than it is to maintain reserves or build reserves large enough for the highest potential losses that they could see and to stay solvent according to regulatory concerns. So almost behind every insurance company, there is reinsurance. Also, sometimes if you had very high property values or your broker would help place what's called facultative reinsurance, which is just for that particular building or some particular risk or hazard that you have, not for an entire book of business with that the insurance carrier carries. The broker, not all, most of them are independent agencies, and that is why they're called a broker. They work for you. They work for the client, for the nonprofit, and their job is to just try and represent you to insurance carriers in the best possible way in order to get you the best possible coverage and pricing for that coverage. The most common kinds of insurance policies that you're going to run across are going to be dependent on your situation, but for the most part, most organizations, most nonprofits will start with a directors and officers liability policy. That is to protect your directors and officers. Usually or often that's needed before you've even started operations, which would be covered by your general liability policy. I'm going to go into each of these a little more in depth, so I'm not going to stay on this slide too terribly long. The third kind of coverage that comes into place is as soon as you have any employees or anyone paid, whether you call it a stipend or a payroll, it ends up putting you in obligation to the regulatory requirements to carry workers' compensation insurance. General liability is covering your operations. It is bodily injury and property damage to third parties. It includes, it usually, unless it's excluded, includes personal injury, advertising injury, a medical payments component, and employee benefits liability. Employee benefits liability is liability for not managing any employee benefits properly. I've actually, in 3 decades, never seen a claim paid under employee benefits. I've seen some almost claims, but I've never seen it. But it's a very inexpensive coverage. And if you're providing employee benefits, it's probably worthwhile to have to protect you. The personal injury and advertising injury often is excluded if it is involving, say, website or some other electronic media, and that then gets picked up under a cyber liability policy. Professional liability. A lot of nonprofits will say, I don't need professional liability because, we're not an attorney, we're not a doctor. Another word for professional liability is errors and omissions, and it's covering mistakes made when providing or failing to provide promised services. So you didn't provide the service that you promised you were going to provide or that you said you were going to provide. So it can include counseling, teaching, coaching, advising, those types of miscellaneous. So a lot of times professional liability to nonprofits is provided under a miscellaneous professional policy that actually excludes licensed professionals such as an attorney or a doctor, and because they should have full-on like malpractice insurance, not just an error or omission type policy for making a mistake in providing or failing to provide those services. Typically, these are claims that are not involving bodily injury. So bodily injury claim would be under your general liability. This is more, you didn't teach me what you said you were going to teach me. We see a lot of those kinds of claims in services for the developmentally disabled or schools and tech programs, things like that. Or you gave me bad advice that caused harm to me, somebody else, emotionally, not necessarily bodily injury. If you're dealing with children or vulnerable adults, you will likely somewhere in some funding contract or somewhere else, but also also probably want to carry some sort of coverage that comes under a number of names. Sometimes it's just called sexual abuse. Sometimes it's called physical abuse. One of the largest nonprofit carriers in California calls it improper sexual conduct. So there's a lot of names for this, but this is covering the bodily injury due to sexual or physical abuse. And that description can have a lot of exclusions in it. Exclusions that come into the general liability policy are because the general liability is going to exclude intentional acts. And usually this type of injury is considered an intentional act. So this gives back some protection for the organization for those types of claims that would fall under that intentional acts exclusion, but will fall within the definition of the policy. This is a non-standard form. Each carrier's form is going to be worded differently and cover different portions. Some of them, for example, will cover defense costs for the alleged perpetrator for a period of time if it's beneficial to the organization, as an example. Others don't provide any coverage for that. So each form is different because it's non-standard, whereas your general liability form is a standard form. Another kind of coverage, which we're all familiar with if we have a driver's license and a vehicle, is automobile insurance. What becomes really important for nonprofits that do not own vehicles, the hired auto and non-owned auto portions of the automobile policy. Sometimes that's endorsed under a general liability policy. Often it is a separate line of coverage. Even if you're an all-volunteer organization, you have a hired auto and non-owned auto exposure in California. Well, you have at least a non-owned auto exposure. California has broadened, in some cases, the claims that can be made under non-owned auto against an organization for, it used to be it was only driving in the course and scope of employment, but I've seen claims and I've seen lawsuits where the person was on their way home from work, but because they were required to have a vehicle for their job, they paid under the non-owned auto coverage. That is protection for the organization, not the individual. They're supposed to have their own policy under their auto to be operating an automobile. They're supposed to have their own insurance policy, and this would be excess of that policy. Those endorsements do allow you to then add volunteers as insureds to your policy, so that when people are volunteering on your behalf and driving their own personal vehicle on your behalf, doing your business, your work, you can also be protected from an automobile liability claim should there be something serious happen. Directors and officers liability, I mentioned this is often purchased even before general liability because you have to form a board, and once you've formed a board, you want the board members to be protected for decisions made by the board members or other covered officers. It's sometimes called nonprofit management liability. That is really just covering the decisions of the board. And then there's another element of that called employment practices liability that can be included on the policy. It can be included in the liability limits, or it can have its own separate limit. Employment practices liability is where you get coverage for things like discrimination and wrongful termination. So let's say your board of directors decides to terminate the executive director, and the executive director brings a lawsuit for employment practices. That would come under the directors and officers policy. Employment practices section, brings a claim for wrongful termination. The directors and officers liability is a non-standard form, although I'd say a lot of the policies kind of have similar provisions available in them. The biggest difference between most of the policies that we see when they're designed for nonprofit is how they're triggered. So some of them can be triggered by an event. As long as the event happened within the policy term, it's covered. Others are the claim must be made and the event or the situation had to have happened during the policy term or during the period that's listed on the declarations page for prior and pending litigation dates. And if it's outside of those two dates, it's not covered. An incurrence policy would be the policy in force at the time of the incurrence. doesn't matter when the claim was made. Workers' compensation, it's required by law to protect your employees from injury, illness, or death on the job. It can sometimes include volunteers. It is an expensive way to cover volunteers for their injuries. What can happen if you want to cover volunteers is you have to assign a salary equivalent value to them. It has to be, actual for the job that they're doing for you. And if you do include volunteers, you can't just include some, you have to include all of them. And so it can become a very expensive way to cover volunteers. What we see most organizations doing, and not every carrier will provide volunteer coverage. What we often see happening is the organizations buying a volunteer accident insurance policy to help cover their volunteers if they get injured while doing work on behalf of the organization as a volunteer. There are no exemptions or exclusions for employees of nonprofits. If you ever hear somebody tell you, oh, we can exclude your paid board members, that is false. You cannot exclude nobody who is paid can be excluded from workers' compensation insurance. That includes a stipend, that includes a paid intern. Everyone has to be covered if they're being paid. Property coverages, I think we're pretty familiar. Most of these are very similar. This is part of what's causing this hard market cycle that we're in right now in California, is we have fewer and fewer carriers willing to write coverage in the state of California. And so this hard market is forcing pricing up as capacity shrinks in the entire marketplace. It is happening in other states. It is happening at a higher, faster rate in California. Your property coverages are basically coverages for any property that your organization owns, including the buildings, content, loss of income if you lose a contract because of fire at your location. And so you lose a contract and you can't provide the services. That would be business income for a nonprofit. Inland marine, any property that moves around. Crime covers your employee dishonesty. Fraud, equipment breakdown is your electronic failure causing your equipment to break down. And then you can have catastrophe coverage, things that are not covered by your general property policy, such as earthquake and flood. You can have those coverages covered separately as catastrophe. Other coverages that are very, very common, cyber liability. I already mentioned volunteer accident insurance, but also participant accident insurance. If you're doing an event, or you have, for example, a bunch of youth, you might want to get participant accident insurance in addition to the volunteer accident. Business travel. This gives you a level of coverage above and beyond an accident policy that can cover your employees, volunteers, anyone, depending on how you write your policy. It's very flexible for travel, both domestically and internationally. Foreign liability. If you're traveling internationally, you need to consider a foreign liability policy. There are exclusions on where policies can have a claim happen to them or have a claim made against them. And most policies, like your general liability, is going to say the claim needs to be brought in the United States. So if you're going to be traveling, you likely are going to need to have a foreign liability policy. If you have a special event, you can that is not covered by your general liability policy or not covered by your other insurance, you can purchase separate special event insurance. But check first to see if it's covered if it is covered or can be covered under your general liability policy. Excess and umbrella liability are limits above and beyond. Typically, they will go over auto, general liability, workers' comp, and potentially your professional, sex abuse, and D&O coverages, depending on the carrier. And then bond. Sometimes you're required for funding or for your city or for some special project to have a bond. So that's another type of coverage that we see fairly frequently. Cyber liability is probably the largest growing line of business. And cyber liability is a very all-encompassing term that can include things like not just notification costs, but also claims from third parties for actual damages. It can also include media liability, tech liability if you're producing an app or some sort of some sort of technology that is being licensed or sold or given. Cyber liability policies can be crafted specific to your organization. But if you have any PII or PHI, or you accept credit cards for donations or banking information, you probably need a cyber liability policy. The cyber criminals are getting more and more voracious, and they're targeting in a way that makes it, breaches very severe, much more severe than they used to be. And some nonprofits have been hit by, they utilize a service, and they have all of there was a big cyber liability incident a couple of years ago that took down tons of community clinics, and those clinics couldn't make appointments. They couldn't then collect their funds from the cities, states, and counties that they provided services for. And so they had some fairly large business income losses that were covered by their cyber liability, even when the ultimate cost for the notification to the people whose information was potentially breached might have fallen on somebody else. There was still coverage under their own cyber liability policies for some of these items. Funding contracts. So I mentioned contracts in the beginning, but funding contracts are something that we see a lot. What you need to ask yourself when you're signing a funding contract of any kind, or any contract, but really this is where we see people are like, we want that grant, we want that money, we need this, and they sign. Nonprofits a lot of times will just sign the contracts without negotiation, without really reading it, and then they give it to us and they say, I need coverage for this, or I need you to give them an additional insurance certificate, without realizing that they agreed to $5 million cyber liability limits, is one that we've been seeing a lot recently, and nobody's going to give it to them, or they'll see things and then they have to go back after the fact when all their funding could be held up on this. So look at your funding contracts, look at it and say, what risks are we accepting? What is the indemnification agreement asking for? Is it one-sided? Is all the risks, and am I indemnifying this other entity and I'm taking on all the risks, or is it mutual? We're both indemnifying each other, and so if either of us is at fault, we'll take responsibility for it. And we see both. Insurance requirements. What are the limits, the types of insurance that are required? What lines of insurance are required? We're seeing cyber, like I mentioned earlier, coming up more and more and more in funding contracts. And are they asking to be named as an additional insured? Does your policy automatically, if it's in a contract, name them as additional insured? And then what is this thing called a waiver of subrogation people keep talking about? Waivers of subrogation are saying that even if their insurance policy should be the one paying for it, you are agreeing to not go after them to get them to pay for it. And a lot of policies will make you pay extra to get that waiver of subrogation. Not all, but some of them will include it automatically by contract if your contract requires it, but others will ask more questions. Typically, your workers' comp policy is going to ask a lot of questions about a waiver of subrogation. So make sure you've looked at those limits, and that if your policy doesn't have them, try to negotiate them to the limits that you have, if at all possible.